wanted to acknowledge that you're all in the right place. As you can see on the screen, we're just waiting for folks to trickle in before we start. So everyone seems to be doing a good job so far of following the instructions of having your microphone muted. So appreciate that. Just hang tight. We'll start here in a couple minutes. All right, well, we can go ahead and get started. Looks like the number of participants is starting to level off here. So hi, everyone. Welcome. I am Mike Leonard. I'm Vice President of Government Affairs for the American Sport Fishing Association. I want to thank you all for taking time out of your busy days here in August to join this webinar, learn a little bit more about the federal excise tax on fishing equipment and your obligations as manufacturers or importers or wherever you stand within the industry and your relationship with the federal excise tax on fishing equipment. Obviously, a really important program that's been around for many, many decades. Hope everyone recognizes the importance of the excise tax and the contributions that you're all making to conservation and to fisheries access and boating access and cleaner waters, all things that ultimately help drive the sport and hopefully help drive more sales into the future. By providing more fishing opportunities. Of course, there are a lot of details, a lot of nuances around the excise tax, and that's why it's important for everyone to be as familiar as they can be to make sure they're all paying their fair share. So we've got a couple of experts here to walk through the presentation. Mitch King, who's an excise tax specialist with the Wildlife Management Institute, and then Sarah Moulton, who is an agent in charge of the excise tax with the Treasury Department. So look forward to their remarks. The way we'll handle this is I'll turn it over to Mitch and Sarah here in a few minutes, let them run through a series of slides that they'll go through with a ton of information about the excise tax and sort of frequently asked questions. But we will, after we get through that, circle back. And if you have questions, there'll be a Q&A session at the end. To ask questions, we'll move on to the next slide here. We'll handle that all here through Zoom. Again, do them all towards the end. There's a couple ways you can ask questions. You'll see just a screenshot, just so you know where to look on Zoom. If you make Zoom full screen, towards the bottom, there's a chat box. That's one of the orange circles there. If you click that, you'll be able to type in a question. You can do that at any point, and we'll get to them at the end. Or if you'd rather ask your question verbally, you can raise your hand. To do that, you click the reactions button and then raise hand. And then I'll probably go back and forth between a chat question and a raise hand question. But when I call your name, you can unmute and ask a question. I'll go through all this again at the end. But thanks again, everyone. Last thing I'll just flag is if you want more information or something in writing, if you all can see this, we at ASA have a bunch of these. Guide to paying the federal excise taxes on sport fishing equipment. If you request one of these, either email me or if you go to our website, you'll see information. Request it, we'll shoot you one in the mail. It's a lot of pages. It's about an inch thick. Most of that, though, is appendices and case studies and whatnot. But the front section has a lot of useful information on sort of the basics of paying FET. So with that, Mitch, I am going to figure out quickly how to make you the host so you can run through your slides. So thanks again, everybody. And with that, Mitch, I am going to turn it over to you. Mitch, you're muted.
There we go. Now let's see if we can do it as seamless as possible. I want to share the screen. I want to share that. I want to hit slideshow from the beginning. All right. Can you see that? Good. All right. Well, perfect. Folks, I appreciate you all taking some time out of your day to sit with us and talk about excise taxes. This is sometimes a pretty dry topic unless you happen to be in the numbers part of your organization, but it is one of the more important topics, and oftentimes it's a topic that can get some of the industry folks in trouble if they get crosswise with the IRS, and that's what our primary purpose here is to try to make sure you don't end up finding out that you should have been paying taxes, or you're calculating them wrong, or whatever. So that's what we're here to do. Just a quick update from me. My name again is Mitch King, and I'm a consultant. I work for the ASA and the state wildlife agencies. Again, my purpose is to try to help you guys in every way possible to make sure you don't end up in trouble with the IRS, and make sure you're calculating your taxes properly so you're not paying too much. I've had about 30 years experience with the U.S. Fish and Wildlife Service. A good portion of that was tied into the excise tax program. I also spent about 10 years with the Archery Trade Association, and a big portion of that was with the excise tax issues and such as that. And so I will also introduce Sarah Moulton. She's the excise tax policy analyst from the Internal Revenue Service. She's on the phone. She's not locked in on video, but she's going to help out in any way she can throughout this presentation. And I'll turn it over to Sarah for a little bit of information from her about her background. Sarah?
Hi, Mitch. Hi, Mitch. Can you hear me now?
I've got you. Yes.
Excellent. I've said that 4 times now. My apologies for not being able to join via Zoom. It looks like that's not going to happen. So a little bit of background about me. My name is Sarah Moulton. I came to the Internal Revenue Service over 32 years ago. Seems like yesterday. My degree is in accounting, so I came in as an internal revenue agent working for income tax, and I was a field agent for many years. And then in 2004, I switched over to excise tax, and that was kind of a new one in the income tax arena, in that they became a specialty that a revenue agent needed more training. So I'm the specialist, and I've been with Excise since 2004, did a little bit of management for a while, did a little of workload selection and delivery, and I've landed in the spot as a policy analyst. So I am the subject matter expert for sport, fish, and archery, and a few other items as well. For any of you that have been to the show, the ICAST show before, or the archery show, you may have seen Tim Bowes. I am the new Tim Bowes. I have replaced him. So I look forward to this presentation, and I will assist in any way that I can in answering some questions with Mitch. And that's it.
Thank you, Sarah. And one of the things that I always like to emphasize is that Sarah is sort of my go-to person when it comes to questions that I have maybe not quite absolutely sure on. I'll circle back to her, and she's always very helpful in trying to make sure we're on the right track. So if you reach out to me and ask a question, you can rest assured that I'll be tag teaming with Sarah in the background to make sure I give you the right answers. So moving on, I want to emphasize something that Mike has already told you, and I don't want you to let this opportunity pass. The ASA, about a decade ago, invested considerable amount of funds and developed a document and the guide to paying federal excise tax for sport fishing equipment. This is an extremely comprehensive document. The IRS has looked it over, and I think everyone feels comfortable with what's in it. Not only does it give you, sort of the basics in the first 20 so pages, it gives you all of the necessary documents for you to read and learn a little bit more about the excise tax program. So don't let the opportunity to get this free document from the ASA by going to the website that's on the page here and filling out a little form. And if you're a member of the ASA, you're due a free document. And one thing I will say is this document is a little dated, but the guts in it are not outdated, I guess is the best way to say it. The ASA is working right now on an update of this document, and when it becomes available, I'm sure you'll be able to reach out and get a new copy of the updated version. But this is something that's very important. I wouldn't wait for the new one. I'd get the old one, and when the new one comes out, you'll have two. Okay. One of the things that I always like to do, and this document helps, is sort of drive all the way back to the beginning and what, where the excise taxes come from and how they sort of link into the industry. And an IRS publication 510 is about a 90-page document that's actually included in the guide to sport fish, the guide from ASA. And that document has anything and everything you'd ever want to know about excise taxes. But really, even though it's 90 pages, there's about 5 pages in chapter 5 that really hone in into what we're doing with sport fishing and archery equipment. So you don't have to read the entire 90. You can just focus on the 5, and you can get an updated version of this publication and any other IRS publications by going to irs.gov and doing some searching in that website for publication 510 and pull out the most up-to-date version. So again, this is extremely valuable information. Urge you to sort of move ahead with that. Again, staying with the very beginning of the excise tax program, the Internal Revenue Code section 4161 is where it all starts. There's a tax of about 10% on sport fishing equipment, and that includes rods, but there's a cap there that's identified of $10 on any fishing rod or pole. So a fishing rod is taxed at 10%, but once you get over about with a tax computation price of about $110, you're capped out at $10 on that as far as the tax due on those. There's also a 3% tax on electric outboard motors, a 3% tax on tackle boxes. And the last bullet there, section 4161A4, also imposes a 10% tax on the parts or accessories, but only if those parts or accessories are sold on or in connection with a taxable sale. Now, roughly, what does that mean? That means if I'll use a reel as an example. A fishing reel is taxable at 10%, and that includes everything in the reel and everything you might package with that reel, like extra handle or extra spool. Those are all taxable. But if someone, and the gears inside that reel are taxable, but if someone comes back at a later date and orders an extra spool or a bail or a handle or the gears, when you sell those to an individual, because they're not sold in conjunction with a taxable product, then they're not taxable. And we'll get into what a taxable product is, and you need to understand that when you start talking about parts. How do you pay the tax? You pay it with an IRS Form 720. Again, you can download this form from the irs.gov website, and there's a copy of one in this large booklet, the ASA guide. It's about a 7-page document or form that has to be filled out quarterly, but in reality, there's just about 4 lines that are of importance to the fishing industry. Those 4 lines are the 4 that are shown here. They're in part 2. And I always like to make sure everyone understands what the IRS collects from everyone as far as information about your business and the industry. And it's pretty gross information as far as being able to dive in and know anything else about the industry. They don't care how many reels you sold. They don't care how many rods you sold. They simply want to know what you owe in taxes in those 4 different categories. I've oftentimes had people say, well, the IRS knows all of this, so surely we can find out from an industry standpoint how many rods are sold in the United States every year. Not the case. The only time the IRS collects any more detailed information is if they're auditing your business, and then they know just about everything about your business. But all of that information is not available to anyone other than the IRS and the company that they might be working with there. So again, a fairly simple document, doesn't require a lot of detail on Form 720 each quarter, but you better have the detail to back it up, because if you ever get audited, someone's going to ask you, how did you come up with a number that's on Form 720 for such and such quarter? And you better be able to tell them that. I said it's a quarterly document. It's due on Form 720 is due on the last day of the month following the quarter. And here are those dates down below for you to give a look at. And you can, if right now, if you look at that, you should be in the middle of the 3rd quarter, July to September, and come October 31st, you'll have to report your sales. And when you report your sales, that's when the tax is actually due. And so you have to submit the Form 720 with a check to the IRS on these deadline dates. I said earlier that it's important to know what's taxable and non-taxable in the and that ASA guide that you have, Appendix A, I believe it is, has a pretty comprehensive list of everything that the IRS has identified as taxable and everything they've identified as non-taxable. And most importantly, they have a section called descriptions and cites next to each one of those items that give you a little bit more information about it. And it's definitely worth the read. I mean, for instance, if you're talking about, back to the parts discussion I had earlier, fishing reels are taxable, but not their parts unless they're sold as a part of the taxable sale. But fishing rods are also taxable, but the rod components are identified as taxable as well. So parts to a rod are not the same as the way I described earlier, parts to a fishing reel. All of those parts, the eyelets, the handle, all of those are identified as taxable products. And even if you sold extra eyelets to someone, you would have to pay taxes on those. A little confusing, but I hope you're following that. And as I think Mike described earlier, if you got questions about any of this, jot them down, get in the queue for asking those questions, and we can go back to these slides and talk through them in a little more detail after I finish here. One of the things I always like to do is talk a little bit about Form 637 registration, because oftentimes I get calls from folks like you with a little bit of misunderstanding about what this Form 637 truly is and how it's used. First and foremost, I'll state it right now, and I'll talk about it at the end of the slide. Form 637 is not a prerequisite to paying excise taxes. You don't have to register under Form 637 with the IRS before you pay taxes or as a part of paying taxes. Form 637 is a process that the IRS has developed to help them keep track of tax-free sale of taxable products. And in the fishing industry, there are only a few ways that taxable products can be sold tax-free. One is if you make a product that's used in in further manufacture by someone else. For instance, if you're making hooks and those hooks are then sold to an individual who's taking those hooks and putting them on a lure and selling the lure, which is a taxable product as well, you can pass on your tax responsibility to that person. That's called further manufacturing. Another one is if you're selling product to a distributor that's ultimately moving that product out of the United States, the 50 US states. Sales that go outside of the 50 US states are not taxable. They're exempt from the tax, and therefore you can work a business arrangement up with that distributor so that the taxes aren't paid on that. So the distributor gets the product for a little less cheaper because they're not paying the tax because it's ultimately going outside the US. Also, if you're making taxable products that are being sold to government entities or to non-governmental organizations, nonprofits, then you can sell that product tax-free to those entities, assuming the product is going to be used in the performance or pursuant of the mission of the entity. For instance, if you're selling fishing rods or reels to a scout organization and they're using that to get kids fishing, whatever, then those can be sold tax-free. However, before you make those kinds of sales, you must register with the IRS through this 637 registration, and the organization or the company you're dealing with must also register. And it's important to note here that you not only need to register, but you need to get a response back from the IRS, and that response is usually in the form of an activity letter. And there's 4 different activity letters that organizations may need to have, 1 or more of those in their possession. If they're going to make tax-free sales. Again, they must have it in their possession, the activity letter. They can't say, I've applied for the activity letter. They got to have it in their hand, and the date on it is critical in your transactions with these folks. I'm just going to run through these activity letters very quickly. Activity letter A is the letter that you would request if you are a manufacturer who is selling a product for any of those purposes that I mentioned earlier. Activity letter B is the response from the IRS you would need to have in hand if you're going to buy a product from someone tax-free and use that product to further manufacture a taxable product. Then activity letter D is the one that you would need to have in hand if you are going to buy a taxable product from a company and then move that product out of the 50 United States for exporting. And then finally, activity letter F is the one that you would need to have in hand if you are a nonprofit seeking to purchase product tax-free from a manufacturer. The only entity that doesn't need an activity letter are the government entities. If you're state or federal or local government, you don't need to have an activity letter. You just need to be able to identify that. And what this all means for a manufacturer is that if they just decide to sell a product to one of these other entities, for whether it's further manufacturing, exporting, or to a nonprofit, they have to make sure that they have activity letter A and that they have copies of the activity letters, either B, D, or F, from the organization or company that they're selling their product to. That needs to go in the file with your information related to the 720 where you're for that particular quarter, and be available for future auditing that might come up. And again, I'll emphasize again, you've got to have that letter in hand. The dates have to be before the actual sale of the product, or you're setting yourself up for a negative finding from the IRS auditor. They look at that very closely. So make sure that if someone comes and asks you to sell a product tax-free, that you ask them for an activity letter. And if they say, well, I've applied for it, you tell them to come back later when you got it. and we'll dive into any questions about that. But again, I'll mention it again. Form 637 and 637 registration, excuse me, is not a necessity for filing 720s or for paying your taxes. It's only for excise tax-free sales. All right, I'm going to step into the next little category that oftentimes is a bit of a question. Seems pretty simple when you ask who the manufacturer is. The manufacturer is anyone that takes material and turns it into something that's taxable. And you're just when you do that, you have manufactured a taxable product, and therefore the tax responsibility is yours. The IRS also treats producers and importers the same as manufacturers. The one point that I'll make here, and the reason I emphasize this in my presentation, is that oftentimes folks will design a product and then reach out to someone who has the capability to manufacture that product. And then the question comes, well, who is the real manufacturer of the product? And in the case I just mentioned, that would be the person that designs it and reaches out to the manufacturer. The people that are actually making it on your behalf are contractors for you. They are not the responsible tax-paying entity. And the price that you would compute the tax from is the price that you actually sell a product to a wholesaler or to some other entity after you get it from the person that you contracted to manufacture the product. Again, I emphasize this simply because I've had several questions from folks about, well, this guy's actually manufacturing this product for me, but he can't sell it to anybody else. He's not the owner of that product. You design it, you stipulate exactly how many you want, and all he's doing is contracting with you to get the manufacturing done. Importer, a lot of the same questions pop up about importer, but oftentimes in more detail, because I think the IRS saw immediately that this was a bit of a quagmire, frankly, when you try to identify who is the importer, and they use the term beneficial owner quite a bit when they're trying to make these determinations. It's sort of the same thing. If you are working with a company in San Diego who is bringing your product into the U.S. and bringing it through and making sure that customs duties and all that are paid, then then some are saying, well, that's actually the importer. From the standpoint of the excise tax, that's not the case. The importer is the beneficial owner of the product, which would be you. If you design the product, if you make the arrangements, or even if the importer makes the arrangements on your behalf for the product to be manufactured overseas, if they're not the beneficial owner of that product, if they can't make the decision to sell that product anywhere in the market that they want to sell it to, if it's your product, you own it. If you incur the loss, if the product it just does not do well on the market, you're then the beneficial owner of the product, and you are responsible for paying the tax. And again, the last bullet I'll say here, I'll mention, is that the tax is computed much like the manufacturer. The tax is computed on the price you actually sell the product for, not the price that you actually pay someone for the product here in the when you get it into the U.S. Or the cost of having the product done. Think about a manufacturer who has cost of materials and labor, all of that kind of stuff. They build a taxable product and then they sell it. The taxes on their sale. Same thing for the importer. If they have costs for import duties to get the product shipped into the U.S., it's not the cost of those the sum of the cost of those expenses. It's the price that you sell it for to the wholesaler, to the distributor, to the individual, the end user. This has been when it comes to identifying the responsible tax-paying entity from foreign manufacturers, and importing, identifying importers and such. It's been quite a management nightmare, frankly, for the IRS and for the industry to try to figure it all out. So back about 10 years ago, the industry developed a number of scenarios of how the businesses, the industry were developing business models, working with foreign-based manufacturing and bringing foreign-based manufactured product into the U.S. And the IRS then went through those scenarios and gave a lot of good narrative on how they came up with a decision of who the responsible taxpaying entity is. And that directive, is identified you in the ASA tax guide, and it's definitely worth the read. If you're involved in any of the importing situations, if any questions popped up in your head when I've been talking over the last few minutes on this, it's definitely worth the read to go to that Appendix H of this ASA tax guide and read through those scenarios and read the rationale that the IRS gave when they were working through them and identifying who the taxable entity is. I think every bit of that is still applicable today, and I assume that'll all be in the new version of this tax guide as well. When does the tax attach? This becomes a real issue if you're selling product and getting paid later. The tax is actually attaches when the product changes hands, when the ownership of the product changes hands. So if you sell something to someone in March and you're not going to get paid until June or July, your tax is due on that sale in April, at the end of April, when you file your 720 for the first quarter of the year. A lot of folks, this becomes an issue with a lot of folks. A lot of questions pop up about this, and I just wanted to emphasize that. Now let's dive into the math a little bit. There's two ways of identifying the tax as part of the selling price. One way is if you sell a product to someone for, say, $100, and you say plus tax, plus the excise tax, then you identify the excise tax on the invoice as $110. I mean, as $10. So the total collection that you have from the end user or whoever you sell to is $110 and not just $100. Then it's pretty simple. The tax is $10. That's what you owe the IRS. But the more common way that folks deal with this in the industry is they actually do what's referred to as tax included selling price. So you'll identify the price of a product as $100, and it's assumed that tax, that 10% tax, is built into that $100 sale price. And of course, then if you follow the math on that I'm going to run through here, you don't really owe $10 on that $100 sale. You owe something less than that. And to do that, you need to walk through this little mathematical process of taking the selling price, dividing that selling price by 1 plus the tax rate. That gives you the true tax price. And then you add the 10% tax rate on top of that. Here's the math down here at the lower end of this for you to sort of follow through. You didn't really sell that product for $100. You actually sold it for $90.91 plus the tax, if you follow that. And the tax of 10% is $9.09. So you owe the IRS $9.09. Again, it's pretty basic math. If any of you are in the financial part of your business, you should pick up on that pretty quickly. There's another way that the IRS allows you to come up with this, or helps you come up with this, and it's really helpful I see it as useful for the fishing industry, because there's really only two taxable percentages that you actually need to calculate and have on hand at all times, because you only have two tax rates. Either you're taxing something at 10% or you're taxing at 3%, whatever it is you're selling. And then the taxable percentage kicks in. You can say my taxable percentage for the 10% sale is 100 divided by 1 plus the tax rate. So it's 90 0.91% is your taxable percentage. Or you say that it's on a 3% deal, it's 97.9%. You're dividing 100 times 1.03. And then you can break out what the actual taxable sales price is, and then recalculate the tax, and that you come up with the same numbers that we came up on the page before. Okay, again, you could take 90.91%, 97.09%, put those on sticky notes and put them on the side of your computer. And in the fishing industry, you basically got it covered. I'm going to spend the next few minutes talking about constructive sales pricing and then what we how to deal with that, because this is the place where the IRS gets called the most bad names when folks are trying to figure out what their constructive sales price is, because frankly, it is very confusing. But I always come out and mention that the reason for the confusion is the industry, not the IRS. The industry, when that excuse me, when the excise taxes were created back when in the 30s, when we were talking about firearms and ammunition, they were created where the business model was basically a manufacturer, most likely one here in the US, sold to a wholesaler, who then sold that product to a retailer. And finally, the end user, someone like myself, walked into a brick and mortar store and purchased the product. That simple business model has, of course, changed considerably over the years. And now with the internet sales and everything else that go on, it's just a real challenge to stay up with it. And every time the business model changed, the IRS would come back and say, well, the true purpose of the excise tax was to apply to the sale from the manufacturer to a wholesaler. And so they were always putting band-aids on the tax computation pricing, and it ended up being band-aids over band-aids. But basically, the IRS is simply trying to get back to that. What would the product cost if you were selling it to a wholesaler? And that's the idea of constructing an actual tax computation price. One of the big questions, and frankly, again, this has been something that the industry has come up with innovative ways to reduce their tax obligations in some cases. And sometimes transactions aren't at arm's length. Family business companies within a larger corporation selling to themselves, that sort of thing, to try to reduce tax owed. And arm's length transaction is something that has popped up in the Treasury codes, Treasury regulations, and this is a real headache, frankly, because this is a phrase that has never been defined that I know of by Treasury, and therefore it's one that it can be whatever they say it is. They tell you, they give you examples. They have the ability, though, to say, nope, that's not arm's length. So be very careful about this one. If you're trying to develop constructive sales pricing based on the sale of something that you make to an entity that it maybe is not completely outside your family of the corporation, or someone where you have a special arrangement with, that may be considered not at arm's length. So be careful with that one. As I get into this discussion about constructive sales price, I want to sort of make sure you understand the three different levels of sale that Treasury regulation ties into. One is if you're selling to a wholesale distributor, that's someone who actually sells to a retailer. If you're selling, a retailer is actually someone whose primary business is selling to an end user. And if you're selling straight to the end user, you're selling at retail. So keep those definitions in mind as we walk through this. If you are in a situation, the IRS has worked up a couple of constructive sales price rules but they only apply if you don't have a wholesale distributor sales price to go by. And what I always like to emphasize here again is that, remember, the IRS is trying to construct a tax computation sales price based on what you would have sold this to a wholesaler if you sold it to a wholesaler. So they're always trying to circle back to that. And if you have no wholesale sales to go by, then you can come back and use these constructive sale price rules that I'm going to talk about here. One of them is if you're selling directly to the end user, sales at retail, and you again have no wholesale distributor prices to go by, you can take a 60% constructive sales price rule. You can use that, which basically means that if you sell something for $100, you can reduce your tax computation price to 60% of $100. So $60 is what you actually owe the tax on, not $100. And you can thank the ASA for this particular figure, because normally this would be 75%. If you were selling archery equipment, you would have to pay tax on 75% of the actual price you sold it on. But the ASA went in and petitioned the IRS that with a convincing set of information that said that truly 60% is more realistic of what would have been a wholesale distributor sale price. So that 60% constructive sale price rule can be pretty significant if you're someone who doesn't sell to wholesalers. So keep that one in mind. Same situation with selling to a retailer. There's a 90% constructive sales price rule, but there's also a little bit of a twist to this. It's 90% of the lowest price of the articles that you sell to retailers. So if you sell a product to that same $100 product to a retailer, one retailer for $70 and to another retailer for $75, you take 90% of the lowest retail price, which in this case would be 90% of 70, so $63 is what you would actually pay taxes on for both of those sales. And so you get the benefit of going to the lowest retailer sales or retailer price. Confusing, I know, but there's some logic in what they're thinking about in this. We can talk more about that during the Q&As. Putting numbers to this. Here's sort of the best way that I see these things. It comes together good for me anyway. If I lay some numbers on the table, and here's a set of numbers for you to look at. If you're selling to again, if you have no wholesale distributor prices to go on, then you can divert to these 90% and 60% rules. And here are the kind of prices you would pay on products at these prices. Pretty straightforward. But if you start getting into a situation where you are selling to wholesalers, then those 90 and 60% rules are sort of out the door, because now you have a regular sale to a wholesaler that you can go by, and so you don't need to develop these constructive prices, because you know what you sell it to wholesalers for, because you've got that information. The biggest twist here is that you pay either the lower of the price you actually sold it for, or the highest price you sell to a wholesale distributor. So if you sell it to one wholesale distributor for $115 and to another one for $125, then for the $115 sale, that's the lower of the two. So you would go to that one for that $115 sale. Again, confusing. Let me get to some numbers and maybe it'll straighten out for you. Here's a list of examples of the same product and the prices that you might have charged for those products to various retailers and to various wholesalers, and of course, then to the end user. The highest wholesale price here is $125. You sell it to these two for one for 115, one for 125. And so in any situation where you're selling it for less than $125, that trumps the $125 price. And you would revert to that when you're calculating the tax for that particular product. And sounds confusing, but here's the math down here at the bottom. $115, you would pay 10% of that, which is $11.50. And for the 120, you would pay 10% of that, which is $12. And for everything else, you revert to the highest price to the wholesale distributor of $125, and everything else is $12.50 if you follow that. So again, I'll let you look at that math for just a second before we move on to the next slide. I always throw this slide in primarily for small manufacturers, that might be coming to ICAST for the first time, that might have at this time have no wholesale distributor prices to go by, but that might be looking for wholesale distributors to start selling to. And it's always important to at least understand the impact of what these coming up with a wholesale distributor that's buying your product might have to your excise taxes. And I think you can see that here. As soon as you start selling to a wholesale distributor regularly, that price starts to override all of the prices and the tax computations using the 60 and the 90% tax constructive price ruling. And so you can see here in red the way that having wholesale distributors impacts your overall tax responsibility. And so, again, I think it's always important to understand that, just to understand the numbers as you're entering into an agreement with someone. But if you're selling a whole lot of product, more product to these wholesale distributors, then you're probably in good shape just to keep on going as you would. I'll start wrapping up here by saying, okay, I've got to want to go back to this federal ASA guide and make sure you understand it's free. And it has everything you need to know, and more importantly, everything your accountant might need to know. One of the things I've found over the years is that there's a whole lot of accountants out there that know state taxes and payroll taxes, but there's not a lot of accountants that really understand the federal excise tax process for the fishing and archery industry. They will be, I guarantee you, they'll be elated to have a document like this in their hand, so that they can better serve you and others in the fishing and archery industry with a better understanding of the excise tax process. I always like to end the presentation by trying to convince people that paying 10% in excise taxes is a good thing, because it does. It's one of the few things, maybe the only thing I know of in the federal government where you actually know where your money's going when it comes to paying a tax. And in this case, you can rest assured the money's going to help support state fish and wildlife agencies and the work they do to hopefully bring more people into the fishing community. And we refer to it often as a cycle of success, because if they bring more people in, you're seeing more people walk through your door buying your product, and everybody walks away feeling good. Again, if you can feel good from paying a 10% tax quarterly, you can learn a whole lot more about this part of the excise tax program by going to this website, partnerwithapayer.org, and there's all sorts of examples for you to look at as to how your excise tax dollars that you contribute are being used. as much as we can, I'd like to leave this slide up, or make sure you take a picture of this slide and reach out to me with any specific questions that you might have. We have again, the arrangement I have with ASA is that all of this they're paying for, or the state fish and wildlife agencies are paying for. And so it doesn't cost you anything to give me a shout and bounce something on. And if I can't, I always, like I said earlier, I go back to Sarah and I ask Sarah for for any input or ideas or thoughts. And Sarah, before we turn it over for any specific feedback or questions, you want to take a few minutes to mention anything that you might want to emphasize?
Sure. Okay, I'm unmuted now.
Yeah.
A couple of things. Most importantly, the website irs.gov as in Victor. That publication 510, I used to call it my Bible when I was out in the field. It's a great resource. It is current. The one that we have in your book is not. So the 510, it's an easy download to, and Mitch is right, there's probably only 5 pages that relate to excise for sport, fish, and archery, but it explains so much more of the ins and outs on excise taxes, and there's many of them. Form 720 is also current on our website as well, as well as the 637 registration. I'm always in favor of anyone that wants to apply for the registration for 637. If you are going to take a taxable product and move it without paying or collecting tax on it, the 637 is the way to go. So definitely register for the 637 early and often. That's about all I have, Mitch. Back to you.
Thank you, Sarah. Good points to share, and now I hope we can get some good questions from you all to fill up the rest of their time. Mike has now captured my hosting responsibilities, and we'll just chime in and answer questions as they come up.
Sarah. All right. So reminder, if you've got a question, you can go to the chat box, or you could also do the raise hand option. If you go down to reactions, raise hand. We've got a few questions in the chat, so I'll just start in the order they were asked. The first, and Mitch, I'll just kick these to you and let you defer between yourself and Sarah, who will answer it. The first one is, can we use the online registration status check for the form 637 instead of the actual form?
That's one I'll pop over to Sarah. I assume you could, but Sarah, what do you say to that? Unmute yourself.
There we go. I'm not sure what the status check is. Is that to check once you've applied to find out if you've received your 637 activity letter? And if so, you need the activity letter before you have a 637 tax exempt status.
If you want to unmute, you're welcome to clarify or ask any follow-up question.
Okay, yep. Hi. Yes, we have, the IRS has a website where you can find out if their 637 is valid when they give you the number, and we've had customers try giving it back to us instead of their actual form, and I'm just wondering if that is okay or not.
I understand what you're saying. So instead of giving you their letter, but I'm going to follow up with another question. Does that mean that they gave you their 637 activity number? And all you did was confirm it on our site.
Yes, that's correct.
That's more than sufficient. Although I would document it. As an accountant, I'm always going to tell you document, document, document. Have that activity letter number
Okay,
that they gave you. That's perfect.
great. Thank you.
And
You're
the only other thing I'll add to that is make sure that you verify that number so someone's not just popping a number to you.
Yes, what comes up on the website is their actual company name, that it's valid, the status date, the owner's name. So it is kind of a validation against what they gave us.
And I assume it identifies the activity letter designation on it.
We have to go ahead and put that in there. So they'll tell us it's activity letter B. And if they don't have activity letter B and they have A, it'll tell us that that's invalid.
Okay, good. Thank you. Yeah, I didn't know that. And I appreciate that, Kristen. That's helpful. So, as Sarah said, document, document, document.
Perfect, thank you.
That the tax included sale price goes away for anyone who doesn't sell exclusively to end user purchasers. Is that correct?
No, if you're doing the tax included sale price, there are end users and there are sales to retailers. Might need a little bit more clarification on what you mean by that question, but so if you're doing the tax included sale price, trying to compute what the actual sales or tax computation price is from that, and you're selling to retailers or to end users, that's important to have those numbers in the process. I don't know that I answered that completely or clearly, but if you know who asked the question, if they got any further input, I'd appreciate it.
Fine.
Hey, yeah, sorry about that. So I guess my question was, we sell most of these SKUs we sell to directly to end users. We also sell to retailers. And in some cases with limited SKUs in our assortment, we also sell to two-step wholesalers. So we've been doing a per SKU per quarter computation based on that situation and using the latter part of what you just talked about, which is computing a constructive sales price and then a federal excise tax owed. What you talked about earlier than that, which with the tax included sales price, I didn't know if that was supposed to kind of be the lead car in my train before I move downward into the computation of construction sales price, or is that if that's something I leave alone, since I'm basically dealing with kind of multi-channels with most of my SKUs at different price levels, obviously, or sales prices, if that makes any sense.
I think it's beginning to make more sense, and I'll ask Sarah first if she's got any input on that, and I'll try to answer, or I can answer. Sarah, if you prefer me to go first.
Go ahead and go first, Mitch.
All right. What I think you're saying is when you're computing your taxes, the tax included sales price applies to everything. I mean, if you're selling it at wholesale, a product for $100, you don't pay $10 on the tax. You got to back calculate out the 10% on that situation. So it would be the 91.09 or whatever it is that you would sell. So you use that calculation across the board to try to identify what your tax computation sales price is. But what you saw in my information is that at the very beginning of the gross sales price, that's tax included, you can reduce those prices down before you do the tax included reduction. It's math. I don't think it matters mathematically whether you do that first or last, but but you still need to walk through that process. And the way we did it on the tables that I had is we did that first. And I don't know if Mike, do you have that? Can you go back to that slide? Might help if you can.
So would I be computing the tax included sales price? And so that would be, say it's $100 to an end user. So that tax computed sale price is your $91, whatever it is. Say I sell that same product to a retailer for $60. Am I then taking that 60 number and also computing a tax included sales price and changing that 60 to something else before I walk the path of constructive sales price is what I'm asking. Again, if that makes any sense.
I think it does. What I would say is no, do it after you walk the path of constructive sales price.
Okay, so once I do constructive sale price, I can then treat that as a tax inclusive constructive sales price before I then do the final FETO'd.
Yeah, that's and that's the way we do it on the slide.
Okay,
The numbers on the slide, I should have clarified that, are sort of the actual sales price of the product. Then you figure out, okay, what's the tax computation price based on constructive pricing, and then you apply the tax to that.
gotcha.
Yeah.
Here. So let me move on to the next one. All right. Are there thresholds for tackle or sport fishing goods based on either components or markets? We were looking at acquiring a company that produced offshore tackle and stated their line is exempt from excise tax. Wondering if there's any validity to this.
Well, based on the last bit of that question, I'd say no, there's no validity to that. I don't know that there would be any situation where an offshore company that's making a taxable product would be exempt from taxes unless that product was, I guess their exemption is for them. But if you end up bringing that in, you're then either an importer or you buy their company, and then you're the taxable entity, or the entity responsible for paying taxes. If I understood that question correctly, and yeah, I'd love to have somebody chime in and give me a little bit more detail. But Sarah, are you comfortable with that, what I said?
Yes.
Thank you. Anyway, if that person wants to chime in and give a little more detail, and if you don't think I answered it, please give me that opportunity.
Yeah, hi, this is Jeff. I think you answered my concern and question. The one stipulation that I've seen as I've been reading through any of the IRS documentation indicated that components or fisheries gear that exceeded 130-pound class categories typically used in commercial applications had an exemption. However, these same products are clearly being sold at retail for non-commercial use for sport fish use. We were looking at buying this company, and that was the calculations that they were arguing the value, and we just didn't see it as being appropriate. Part of why I'm here today is really just to see if there's any validity to that. If we ended up getting into the offshore markets and anywhere else, is that 130-pound class gear make any differentiation in taxability or tax liability?
Well, thanks, Jeff. That's very helpful for me to think about my response to you. The 130, the commercial gear is not taxable, but because recreational gear has gotten so big, and some have tried to suggest that it's really not recreational gear, it's commercial gear. Fishing line is about the only line that I know has a specific 130-pound break point on it, where anything that has a weight limit above that is considered commercial. But when you look at these large rods that are advertised as being, recreational fishery and stuff like that, or large reels, I think you start getting into a real gray area if you start claiming that they're commercial gear and not recreational gear. Sarah, what, am I close on that, or you want to weigh in? If not, I can talk to Jeff directly.
I'm going to skirt around that because it's
Okay.
kind of a substance of form question.
Mhm.
And, you know, when that law was originally written, it was because it was for sport fishing versus trying to make a living versus commercial fishing. But we are seeing more and more gear that's for larger fish. So I'm going to be careful. I know how the law was written and when it was written. I would say substance over form on that one.
Yeah, and I agree, Sarah, and thanks for that. I think, you know, when you start getting into looking at how it's advertised, all of that kind of stuff is going to play into this, Jeff. So this is one I'd be real careful about. It sounds like a logical argument to avoid the tax, but in fact, it may be one that gets you in trouble at some point in time. And there are situations where you can actually go in and ask for the IRS to give you a letter from them based on the specific information for your specific product, and you get those letters, and then you can take that to the bank. You can basically show that to an auditor, or that this is a tax exempt product because it's a commercial product. And that would be the way to get your answer that you need before you dive into an arrangement like this.
Question and reminder, if you want to ask a question, the chat box seems to be the popular way to go. You can use that, or you can also do the raise hand function. But here's another one. We recently purchased a soft plastics brand. The folks we purchased from will continue to manufacture the baits and sell to me. I was told by them that since I will be the second seller of the product, that the excise tax does not apply to these products. Is that true?
Short answer, I think, is no. If you own the brand, then you own the responsibility for paying the taxes. And if that person, this is where my presentation, I mentioned the idea of defining whether or not you're the manufacturer or not. If that person has the ability to sell that product as if they own the product, they could sell it to other companies, to your competitors, whatever, then they are in fact the manufacturer. But if you have made some business transaction with them and you've purchased that product from them, purchased the brand from them, then they no longer have that. You are the manufacturer. Even if they are, selling or pricing the contract manufacturing they're doing for you on a per unit basis, you still are the manufacturer of that product.
Is there any follow-up to that? Okay. There's been a few questions, people just asking for the slide deck. You can email me or Mitch, probably you'd be happy to as well. Just email either of us and we're happy to send you the PowerPoint slides. It's easy enough. Are there any more questions? If someone hasn't used the chat box or the raise hand, just wants to simply unmute to ask a question, you're welcome to do that too. Okay, one just came in. If a manufacturer pays the tax, but then we mark up a product we rebrand, do we owe tax on the markup?
When you say mark it up and rebrand it, are you doing any further manufacture to that product, or are you just putting it in a package?
There'd probably be some labeling and that kind of thing on it.
Okay. Sarah, what are your thoughts about relabeling, repackaging product. Is that considered further manufacture, or what do you think?
Where's the risk? For example, your product is coming in on freight and that train derails. Who suffers the loss of that product? You or the original manufacturer?
Well, in this case, it'd be the original because we haven't gotten it yet.
So you didn't pay for it up front?
Well, so the manufacturer, they actually pay the excise tax on the stuff they sell to us. Right? But then somebody had suggested to me that, hey, we get this stuff, so excise tax is paid on our acquisition cost, but then we relabel it and do a few other things to it. So therefore, we've changed it, and we need to then pay the excise tax on the difference between the acquisition cost and the sales price. And I just wanted clarification because I seem complicated, and if I'm going to do it, I want to make sure I have to. So,
Well,
I
My
think
gut-
that's
go ahead, sir.
I think that's a fair assessment.
Yeah, that's where I was going from this. One of the things, Andrew, that causes me to react just a bit is is when you say you relabel it and quote, do some other things to it. You know, maybe we could sit and talk about what those other things are but yeah, if you're improving the product in any way, then that would play a part of it. It would be calculated the way that your information source told you. And so that's probably the safe way to go about it. But I'd like to talk to you a little bit more detail about that at some point in time. If you want to give me a call.
sure, that'd be great.
And that guidance goes for anybody here on the phone. If for some reason you don't want to talk about your specific situation, feel free to reach out to me. My number was on the slides, and I'm sure Mike can make that available to everyone. And we'll I'm like I said, my time is paid for unless you just wear me out. Then my time is paid for through the contract I have with the ASA and the state wildlife agencies, and I'll give you my best advice I could possibly give you.
Type in the chat box, or you can go ahead and unmute if you want to be so bold. All right, well, seeing and hearing none. Mitch, Sarah, any closing remarks? Sure, reiterating, Mitch, and appreciate your availability. Your contact info, I'll be sure to send that around to everyone that's on here. The slide deck, Mitch's contact info, and information on how to request our physical guide, if anyone's so interested. But Mitch, Sarah, any closing remarks?
Sarah?
Sure, I'll start. First of all, thank you all. I appreciate the opportunity anytime I can come out and talk about excise tax before it becomes an issue because you didn't collect it and you didn't pay it in. Mitch alluded to, and he mentioned it and did a nice job with, this is one of many taxes, it's not the only one, that 100% goes back into that trust fund, and it's a conservation fund. The IRS collects the excise tax, and 100% goes over U.S. Fish and Wildlife, and then they do it federal, and then they disseminate it through the states. It's a tax that's been set up so that hopefully more anglers are out there. Hopefully, you know, whether they're doing hatcheries or whether, and I don't mean to get on the kick of partner with a payer, definitely go look at that. That's a wonderful site and resource. But they definitely have the conservation funds going out so that hopefully end users are coming and purchasing your product. And that's what we're looking at. The 637s, always going to recommend that. If you want to take a taxable item and not pay the tax or collect the tax to pay into us, fine, get yourself a 637. When it's questionable, what Mitch mentioned was a private letter ruling. That is something that costs some money when you apply for it with the Internal Revenue Service. And I would recommend that in situations where you're trying to distinguish a very spot on product, not like a vision, but this is what we are manufacturing and this is why we think it should not be a taxable item, then yes, by all means go for that private letter ruling. It does not hold up if your neighbor tries to use the same letter ruling. That would be just for you and your product. But it's definitely a great alternative. And besides that, please reach out to Mitch. Mitch is correct. We talk and we discuss issues and cases and what's new with the industry. And I've only been here almost 2 years now. We've seen some issues that are going on that industry came to me and said, hey, Sarah, there's a problem, and I have elevated it. I do listen. We are concerned with some stuff that's going on with the industry, and most of it would be the disadvantage you have on people that are now purchasing straight from a manufacturer outside of the US. And so I hear it and we're talking about it. And I know that your industry has gone to Congress about it, and I support. I think that's wonderful. So please keep in mind that Mitch is a great resource. And on that note, I'm handing it over to Mitch. Thank you all.
Thanks for that, Sarah. And yeah, just to echo Sarah, throwing some accolades towards Mike and the folks at ASA. I think the big issue that we've heard talked about quite a bit is this internet sales activities and the impact of that on the industry. It's not only your industry, but it's also the archery industry. And Mike and his counterpart in the archery community are doing a great job of trying to keep this alive. The wheels of government turn slowly, and we can all attest to that. But I think I think there's beginning to be some light at the end of the tunnel on that issue. We'll get to that at some point in time. Hopefully we'll have a big seminar about that.
Yeah, well, thanks, Mitch and Sarah. Yeah, a little surprised, I guess, maybe slightly pleasantly that didn't come up earlier on the webinar. But yes, we are hard at work trying to get better understanding and the need for resolution of the issue of products manufactured overseas being sold directly to consumers, primarily through online marketplace facilitators, and no excise tax collection in the process. Not something the originators of the forefathers of the excise tax system anticipated becoming a thing back in the 1940s and 50s, but certainly the way a lot of commerce is done these days. And something, I don't know if loophole is the right word. I think slippage is a word we've been using a lot to describe it. Something that's ultimately resulting in unfair competitive practices and lost excise tax dollars, lost money for conservation, and a problem that's only going to get worse over time. So something we absolutely need to get fixed. But doing so in a way that's specific to this issue and doesn't open another can of worms has been part of the challenge. So, but we're hard at work at it, and hopefully we'll start to see some more momentum here in the near future. So, well, unless there's anything else, last second, Mitch, Sarah, thanks again for doing this. Thanks everyone for joining. These are always, I think, really valuable. You know, no one wants to go into this feeling uncertain. I think everyone wants to do the right thing, but they also want to do the fair thing. So if you have any follow-up questions, again, reach out to Mitch. I'm happy to facilitate that as much as I can. And we'll, again, send around a recap to everyone with some of these materials. So with that, we'll close it out, and have a great rest of your day, everyone. And we'll stay in touch on this and a bunch of other things we have going on at ASA. So take care, everyone.
Thank you, Mike.
Thank you.